The United Nations just put out an article titled that policymakers could trigger a recession worse than the 2007 crisis. And let me read you the opening line from this article. It says that the world is headed towards a global recession and a prolonged stagflation unless fiscal and monetary policies are quickly changed. Essentially, what they're warning is that central banks around the world are raising interest rates too quickly to fight inflation, and this fight on inflation can push the world into a deep global recession and stagflation. On top of what happened with the UN's warning, you have Credit Suisse, which is one of the largest and most influential banks in the world, who just put out their own warning. What they're saying is, well, they could be running out of money. They are facing potential solvency issues and could be facing a potential collapse depending on what they do next. And then we have the jobs report that just came out earlier today, which said that job openings have fallen by 1.1 million in the month of August. Just remember, jobs reports are a little bit lagged, so we get August reports now here in October. This is a gloomy day here in Manhattan, and let's talk about what's going on in the world and the economy right now. First, let me start talking about the UN, because the United Nations put out a pretty dire warning about this global recession. So let me read you a few things about what they're saying and what they're proposing. So essentially what they're saying is this global slowdown that is happening due to these rising interest rates, it will expose, quote, developing countries to a cascade of debt, health, and climate crises. And what they're saying is that we are on a path right now to see our economy contract to pre-COVID levels, and that we could lose something like $17 trillion worth of productivity. And even though these things are happening with the slowdown, the United Nations is criticizing central banks, saying that central banks are sharply raising interest rates, threatening to cut off growth, making life much harder for those heavily indebted. Essentially what they're saying is that the world is facing essentially a debt crisis, that you have countries, companies, and people around the world that are so deep in debt, that have been so reliant on these super low interest rates, that now, as we're facing the price of all this inflation and the price of all these low interest rates for the last 14 years, because we've had interest rates near zero since the 2008 crash, now that we're working to normalize interest rates, that countries, companies, and people can't stand it. And it's causing a global recession, a global slowdown, and potential stagflation, which could really hurt our economies, and it can really hurt people. And they're saying that it can also hurt our health and climate change. And the big thing that they're talking about is debt. It's saying that 60% of low-income countries and 30% of emerging market economies are near debt distress. And so because you have so much of the world that is drowning in debt, these rising interest rates are going to have very painful consequences. And so they're putting out a warning telling countries and central banks to stop doing that. Now, this brings me now to Credit Suisse, because they also ran into some debt issues. But on the other side, they're not giving a warning about what's happening with debt. Instead, they're talking about what happened with them and their debt. Now, we did cover all of this in Market Briefs, which is my free financial newsletter. If you have not joined Market Briefs yet, I highly recommend you do that. It is a free resource that I created where every day my team is breaking down what's happening in things like the global economy, the stock market, real estate, inflation, and cryptocurrency. And so if you want to stay up to date, if you're an investor and you want to see what's happening, when it's happening, you got to join Market Briefs. It is a free resource and you can read it in less than 5 minutes every morning. So if you want to join Market Briefs, I got the link for you down in the description below. So Credit Suisse ran into some hot water because they had made some bad acquisitions in the last number of years. They had bought some hedge funds which failed, and they used debt to buy some of these hedge funds. And so they made these risky investments essentially with debt that failed, and this caused a solvency issue for Credit Suisse where essentially they lost a lot of money. And because they lost a lot of money, people started to sell the Credit Suisse stock. Their stock is down over 70% in the last 5 years. And now, because they've been running out of money, they recently said that they want to start issuing more debt and potentially stock. That way they can raise more money. This has people worried about solvency issues with Credit Suisse. Are they making too risky of investments? Now the interest rates are going up, their cost of servicing their debt meaning their debt payments are also going to be going higher, even though they've had all these bad investments. And so what does this mean for Credit Suisse? And it has people worried about potential solvency issues, potential failures at Credit Suisse. And so their CEO came out and wanted to calm investors. And what he said was that Credit Suisse is working to reassure their staff and their bankers that they have a strong capital base and liquidity position amid market concerns and amid their credit default swaps. Now, if you remember what happened during the 2008 crash, credit default swaps were a very popular thing. Credit default swaps were essentially insurance against something. So back during the 2008 crash, credit default swaps became very popular, where you could get a credit default swap against a bank or against mortgages failing. So if you thought these mortgages were going to fail, you could get a insurance position against an investment. That's what a credit default swap was. Well, credit default swaps have been skyrocketing against Credit Suisse. Essentially, people have been buying up these insurance positions against the Credit Suisse bank because they're worried that Credit Suisse could run out of money, potentially fail, and that's when you would cash in on this insurance position, the credit default swap against Credit Suisse, and they have been skyrocketing because people are very worried about Credit Suisse. And then they put out a very interesting statement, which had to do with why they are now working to raise more money, because there's been a lot of criticism against Credit Suisse that you're saying that you don't have liquidity issues. You're saying that you don't have a money problem, yet you are working to raise debt, and you're potentially talking about selling more shares to raise money at a lower share price, at a diluted share price. So you're willing to lower your share price in order to raise more money. Why would you do that? And they put out a statement saying, quote, I think a lot of investors will make the point about why does the bank need to raise capital if solvency is not a concern? But it's really to address the negative sentiment and very much the issue in terms of perception of counterparties. So they're saying that the reason why they want to raise money is not that they're having money problems. It's not that they're potentially facing a solvency issue. The reason why they're raising money is so people think that it's still a good investment, that they still have a lot of cash. So kind of an interesting way to phrase it, something you want to keep an eye on over the next 6 to 12 months, what's going on with Credit Suisse and how their liquidity issues progress, especially as interest rates go up, because that's going to make business more expensive. This brings us here to the United States with the job report that just came out this morning. And the headline for the job report is that about 1.1 million job openings decreased in the month of August. And there's some speculation as to what this means. Does that mean that lots of people got more jobs, so jobs filled up? Or does this mean that companies are just removing some of the job postings because they don't want to keep hiring people in the midst of an economic slowdown, in the beginning of this recession, if we're not already in a recession? Because every single day it feels like more and more people are starting to realize that, oh no, our economy is slowing down. We could be facing a deep recession. We could be facing stagflation. I mean, we've been talking about it here on this channel for over a year now, but now more and more people are starting to see the consequences of raising interest rates, seeing the consequences of inflation. And this is where now you have kind of two different opinions about this job report, that maybe this means that more people have jobs, maybe this means that more people are getting jobs, maybe this means more people are happy with their jobs, or maybe this means that companies are pulling back their jobs. And this is one of those things that the Federal Reserve Bank does look at. They look very clearly and openly at the jobs report, more particularly how many jobs are open, because prior to the month of August, this report that just came out, there were approximately 2 job openings for every job seeker, which is very high. And that's one of the things that the Federal Reserve Bank said, that they wanted to cool down. They wanted to cool the labor market because they wanted to have less job openings per job seeker. They said that the job market is too strong, that they wanted more layoffs. And so that was fuel for them to continue raising interest rates. Well, now that we have this new jobs report saying that we now have about 1.67 job openings to 1 job seeker, still very high, but this could be more fuel now for the Fed to say, okay, we can ease our fight on inflation, or they might take that to say, we still have more ammunition to fight inflation strongly. So you have a lot of forces around the world. The United Nations, you have companies, you have some investors that are saying the Fed needs to stop. They're too aggressive to fight inflation. They're getting too strong to fight inflation. It's hurting the economy, it's hurting the world, it's hurting people, it's hurting investments. But at the same time, you still have inflation near record highs. And you have a lot of people saying, well, what do you want to do? Do you want to face a recession or do you want to face a currency crisis? And this is where the Fed is going to have to make a decision. Do you want to pay the price of a recession today, which is painful, or do you want to pay the more painful price of a potential currency crisis in the future because of extremely high inflation? And this is the thing that you want to pay attention to. And this is the battle and the decision that the Federal Reserve Bank is going to have to make before the next meeting in the first couple of days of November. So you want to be paying attention to this. And this is where understanding that whatever happens, you want to be the one that can capitalize on the opportunities around you. That means investing your money, looking for discounts in the asset markets, stocks, real estate, potentially cryptocurrency, where now you're looking for the opportunities. And if you have the cash and the education, that's when you can come in and buy when you see asset prices go on sale. Once you figure out how to control and manage your savings, the next thing that you want to work on is your earning, because the last thing that you want to do is live like you're in poverty for the rest of your life. I mean, you want to live below your means, but you don't want to live small the rest of your life. Sure, yeah, I don't have the nicest car right now, but I do have the nice things that I want because a car is not very important to me. There are other things that are important to me.